Alors pour commencer, en premier, merci beaucoup pour l'occasion d'être ici aujourd'hui. Thank you very much for the opportunity to be here today. I'll be talking about my paper, Intra-Household Labor Income Responses to Changes in Tax Rates Among Older Workers. And of course, I'll start with a simple caveat that the views and opinions expressed here are solely those of the author and do not necessarily reflect the views of StatsCan or the Government of Canada. So, I'd like to start with just a very quick motivation on what I think is pretty obvious given the nature of this conference, but suffice it to say that workforce aging poses significant challenges for economic growth, for national savings, and for the solvency of public pension systems. And that's true in Canada, that's true in many other countries as well. This is in response to such pressures as the retirement of the baby boom generation, increasing life expectancies, and many other factors. In response to these pressures, what we've also been seeing is that governments have been raising retirement ages, strengthening work incentives, and otherwise redesigning pension systems in a way to keep workers in the workforce longer, or in other words, to keep them off of the social security net longer. And to some extent, these reforms are motivated by a large literature in economics, which finds that individuals' pension receipts or their retirement decisions are very responsive to the types of incentives that these programs create. All this to say that understanding how policy levers affect the labor supply decision, and I should say as well, understanding not only how policy levers, but which policy levers affect the labor supply decision of the elderly is becoming increasingly important. But despite the large literature on how individuals respond to pension systems, there's almost no empirical evidence on the extent to which they're responding to changes in the tax system. There's a large literature that investigates this issue, how labor income responds to changes in taxes, but it tends to primarily focus on younger or middle-aged workers. And so as a result of that, for purely methodological reasons oftentimes, how older workers are responding simply gets swept under the rug. In fact, older workers who may be the most responsive are not being included in this analysis. And so a better understanding of whether older workers respond to changes in income taxes has important implications for policy. And one example of that would be age-dependent taxation, which some economists have been advocating for a little while now. And so against this background, what this research does is it addresses the following two questions. The first question being, does labor income respond to changes in effective tax rates among older workers? Or put differently, can we think of the tax code as another viable policy lever for influencing labor supply and retirement decisions? And specifically to provide new insight into this important issue, I'm going to be focusing on the Canadian context and a particular tax reform enacted a couple of years ago in order to do so. The second question that this research addresses is, are there intra-household or are there cross-spouse responses to tax reform? And when dealing with older workers, this is especially important given that retirement decisions can often be codependent. To preview the results, what I find is conditional on working, so for individuals who are in the labor market, conditional on this fact. What I do find is that they're fairly responsive to changes in tax rates, but perhaps a little bit surprisingly, they're not so responsive to the marginal tax. In fact, they appear to be responsive more so to the average tax rate, even controlling for income effects of changes in tax liabilities. Along the extensive margin, or in terms of their participation decisions, we also find significant responses. And in this case, a 1% increase in after-tax income tends to be associated with about a 1.6 to 2.3 percentage point decrease in the probability of working. And in certain circumstances, not all, but in certain circumstances, I also find that there are significant cross-spouse effects of a tax reform, and I'll speak a little bit about this as well. So as you can sort of infer from the two research questions separately, in addition to providing new insight into how older workers respond to taxes, one of the main contributions of this paper is to try to bring together two literatures that have so far evolved relatively independent of each other. The first one being responsiveness to changes in tax liabilities and tax rates, the other one being this intra-household or this cross-spouse responsiveness. I'm also going to present some evidence of what's called smedgeling behavior. I didn't coin this term, but I will say the more I present this paper, the more it becomes fun to say. But I'll say a little bit about what I mean by that as well. Okay. The data set that I use in this study is called the Longitudinal Administrative Data Bank. So for those who are unfamiliar, the LAD is a 20% longitudinal sample of T1 income tax records from the central tax authorities of the Canada Revenue Agency. And it provides a wide range of information on demographics, income, taxes, credits, transfers, allowances, tax-preferred savings, and so on and so forth. So this is a very rich, very longitudinal, very long-spanning data set, which is particularly useful for studying savings and labor supply decisions. At this time, I should say, for those not from Canada in the audience, one of the unique characteristics, or I shouldn't say unique, pardon me, but one of the characteristics of the Canadian income tax system as compared to, for example, the income tax system of the United States is that the unit of taxation is the individual. So there are credits and allowances and certain characteristics that recognize economies of scale of marriage, but by and large, the unit of taxation is the individual, and each individual has to separately, the individual and the spouse, has to separately remit their tax returns to the Central Tax Authority. The LAD, what's nice about this is that it derives from the T1 family file. And the T1 family file is a data set that has actually linked the individuals and the spouses together in order to have information on couples. And of course, for an intra-household or cross-spouse study, that's particularly important. We'll be focusing on tax years 2005 to 2008 for reasons that we'll be looking at a tax reform that occurred during this window. And for methodological reasons that I don't need to get into today, I'm also going to be focusing on a cohort of individuals born between 1937 and 1953. So to give you a sense of what these individuals look like, on average, they're 60 years old. We see that about half of them are female and 100% of them are in married or common law relationships. The reason for this sample restriction is that because we're looking at cross-spouse effects, there has to be a spouse present. In addition to that, we see that about 2/3 of individuals and their spouses are in the labor market to at least some extent. They do have some labor market earnings. And about 44% of the time, we see that at least one individual in the household or in the couple does have at least some income from private pension plans. So there's at least one pensioner in every couple about 40% of the time, 44% of the time. The general class of problems then in a study such as this is to estimate how labor income responds to changes in net of tax shares, or in this case, the 1 minus the tax rate, controlling for other characteristics that change both across individuals and over time that could either directly or indirectly affect this behavior. I refer to it as the net of tax share in the sense that it's you can think of it as your take-home rate. If your tax rate is 20%, then 80% is what you take home. And because we're estimating this in logarithmic form, we can think of beta as the parameter of the estimated elasticity of taxable labor income to the net of tax share. Now, the problem with just directly estimating this equation by ordinary least squares is that the tax rate is in turn a function of your labor income. And this is by design because of tax progressivity. So because of this reverse causality bias, what we would actually expect if we were to just run this by OLS is a downward bias on our parameter of interest. One of the approaches for resolving this issue in a reduced form sense in the literature is to find a tax reform that changes tax liabilities and tax rates exogenously and to exploit that in empirical identification. So that's what I'm going to be doing here. The specific reform that I'm going to be looking at is the introduction of pension income splitting, which occurred in 2007. As I said, the unit of taxation in Canada is the individual, but you can sort of think in a bit of a crude heuristic sense, you can think of what this introduction did as changing the unit of taxation from the individual to the couple on income derived from private pension plans. So what this effectively does is it allows the high pension income earner to send or to split some of that income with the low income earning spouse in order to reduce that individual's tax rates and tax liabilities. It does bump up the tax liability of the spouse a little bit, but because of progressivity, it has the effect of lowering total household tax liability in some cases. And so what we end up with is change over time as a result of the introduction of this reform in tax rates and tax liabilities within the household across spouses, given whether they're the high income or the low income earner, as well as a couple of other characteristics. In particular, there's this feature of the plan where all private pension income is eligible for splitting if the pensioner is 65 years of age or older. If the individual is under the age of 65, then that income has to derive from workplace pension plans in order for it to be eligible for splitting. So there's some spatial variation here that we can exploit. There's some time variation as well. And the way that I do that is by using the Canadian Tax and Credit Simulator program. If you're not familiar with CTAX, it's basically the Canadian equivalent of the US NBER tax sim program. So thanks to Kevin Milligan for making this publicly available, and to Tammy Shirley for all the coding that went into that as well, and many others, I'm sure. And effectively, what we can do with this program is we can estimate, holding everything else constant, how tax rates and tax liabilities would have changed between 2006 and 2007, purely as a result of this reform. So taking all the characteristics constant of the individual and the spouse in 2006, putting that through the system and predicting tax rates and tax liabilities, what would have come out in 2007 with splitting, but everything else constant. And we can use this predicted measure of tax rates and predicted measure of tax liabilities as an instrumental variable for the actual changes in a two-stage least squares approach. To give you an idea of how good of a job this instrument does, what I'm plotting here is the percentage change in labor income relative to the percentage change in the marginal net of tax share between 2006 and 2007. And the steep the steep downward line that you see there is the actual relationship in the data. Not surprisingly consistent with tax progressivity, it's what you would expect. The instrument, on the other hand, is the dotted line, which is more or less horizontal. So it really does appear as though the instrument is doing a good job of overcoming this downward bias problem. Okay, so on to the first question then. Does labor income respond to changes in effective tax rates among older workers? And I'm actually going to be estimating this along two different margins. The first margin is going to be the intensive, so conditional on being in the labor market. How does your labor income change and respond to this change in taxes? And there's a, okay, that's good. And so we're estimating the change in labor income relative to the change in tax rates, as well as the change in total tax liability, controlling for all these other characteristics that could either indirectly or directly affect this, this responsiveness. So basically, we're just going to throw in the kitchen sink as well. The second margin of analysis is the extensive margin. So here, we're effectively doing the same thing, but we're just changing the dependent variable to an indicator of whether or not the individual is observed having any labor market earnings in that year. What do we see when we look at the results? Here I'm plotting, I'll go through each of those in turn, so I'll start with the intensive margin. What I'm plotting here is the marginal net of tax share and its effect on labor earnings conditional on being employed. And so in the ordinary least squares estimate, this is basically just the OLS estimate of that downward relationship I already showed you. Not surprisingly, it's significant and it's negative. When we use the instrument in either a reduced form or a two-stage least squares approach, it actually becomes positive, suggesting that people are responding to the change in their marginal net of tax share. If their marginal net of tax share increases, they'll actually earn more. Now, one thing to note in this estimate is that, or I should say one thing to note in this approach, is that whenever there's a tax reform, two things are changing. The first thing is that the marginal tax rate changes. So on the next dollar earned, how much you get to take home is changing as a result of the reform. The other thing that's changing is what's called the inframarginal effect, or it's basically an income effect of the reform. So not only on the next dollar earned does the rate change, but on all the earnings up to that point, your tax liability is changing as well. So there's an income and a substitution effect that we need to control for. Here, this is uncompensated in the sense that I'm not controlling for income effects. When I do control for income effects, on the other hand, it appears as though the significance drops substantially and becomes insignificant and close to zero. So the conclusion from this is that after controlling for income effects of the reform, there does not really appear to be any empirical evidence suggesting that older workers are responding to their marginal net of tax shares or their marginal tax rates. Along the extensive margin, it's slightly different. What do we see in this case? Well, I just want to focus, I guess, on these two estimates here. It does not appear, again, that individuals are responding to their marginal tax rates, and in the paper I have a theoretical justification for this, which is it builds on other papers as well. It's not all that controversial, but exactly as we would expect based on the theory in the paper that I'm obviously not showing here today, individuals are in fact responding to at least the income effect of these reforms. So what this tells us is that for an additional 1% increase in total after-tax income resulting from a change in tax liabilities, 1% increase reduces the likelihood of being employed by about 1.4 to 1.6 percentage points. And so along the intensive margin, we're not seeing very much responsiveness. Along the extensive margin, we are. And so this, to some extent, raises the question of why along the intensive margin are we not seeing very much response? And there's a variety of different reasons to explain this. It could very well be the case that individuals are sort of locked in. Their employment contracts are fixed. They either work 20 or 40 hours a week and there's not a lot of flexibility. It could be a strict preference for full-time employment or what have you. There's a variety of different explanations for this, sort of in a standard rational framework. Another possibility that I want to explore today is this idea of scheduling. This idea that individuals may use the average tax rate as a proxy for the marginal tax rate, when in fact marginal prices or marginal tax schedules are very complex. Now, the simple, the direct marginal tax rates applied on income are fairly transparent and well described. But once you actually start calculating effective marginal tax rates as a result of all the other programs that come into play and stop coming into play along the income distribution, effective marginal tax rates are a lot more complex. And so the way that we can test for the effect of, or the differential responses in marginal and average tax rates are simply by taking the net of tax share for the marginal, the net of tax share for the average, dropping them both into a regression framework and testing to see if one of them comes out significant. So it's effectively an encompassing test. Just to give you a little bit more graphical justification for this approach, here what I'm plotting is the marginal and the average tax schedules for the individuals in this sample across the income distribution from $0 to $60,000. The reason why the average is below the marginal is simply because of tax progressivity. But what we see is, even in this sample, we can infer that there are discontinuities in the marginal. So of course, it's an infinite change in the marginal tax rate, or an infinite marginal tax rate as you enter the labor market. At $3,500, where the Canada Pension Plan or the Quebec Pension Plan basic exemption ends, you see a large increase in the marginal. You see a slight increase here at the federal basic exemption. You see another one at the second federal tax bracket, and then at the year's maximum pensionable earnings for the Canada Pension Plan or the Quebec Pension Plan, you see a drop, where the social contributions to this plan at the margin go to zero. In contrast, you just don't see any of that discontinuity in the average. So in addition to the fact that the average is easier to calculate just in a basic sense, this is what I'm going to earn this year and this is how much I'm expected to pay in taxes on average. It's also easier to understand for an individual at a particular point in the income distribution once you start taking into consideration all the other characteristics that go into determining effective marginal tax rates. And I should say this is the case in the Canadian context. There are other studies, for example, in the United States that talk about when you incorporate Medicare and Medicaid, food stamps, welfare benefits, and all that type of stuff, you get the same complexity of tax codes in other countries as well. So certainly I think the findings from this study are transcend borders, I should say. So what do we see when we look at the intensive margin response controlling for both marginal and average? Well, when we don't control for income effects, again, both seem significant. When we do control for income effects, really the only one that survives is the average. So it does appear as though individuals are responding to changes in taxes. They're just not necessarily responding along the intensive margin exactly how we would expect, for relatively simple and straightforward reasons, perhaps. Along the extensive margin, in contrast, what we see is that, again, the results are quite robust to what we were finding before. Neither the average nor the marginal appears significant in this last column. It's really only the total after-tax income, and that's consistent with what we would expect based on theory as well. So it does appear as though there are different types of responses for different types of individuals at different points in the income distribution, whether they're working or not, whether they're deciding whether to work or how much, but not necessarily always consistent with how standard theory would model these types of responses or this type of behavior. So given the findings from this part of the paper, the second question then is, are there intra-household or are there cross-spouse effects to the reform? To what extent do these effects spill over onto spouses? And there are two different types of responses that I want to consider. The first one being cross-spouse income effects, and I'll tell you what I mean by that momentarily. The second one being cross-spouse labor effects. What's nice about, I guess, first of all, the fact that the unit of taxation in Canada is the individual, and second, the fact that this reform had differential effects on individuals, whether they're the high or the low income earner, is that we can exploit this spatial variation in order to separately identify individuals and spouses' responses. Okay? So the cross-spouse income effect comes from this idea that from a collective model of family decision making. The idea here being that if individuals and their spouses are making labor supply decisions together, then a dollar dropped into the household is a dollar dropped into the household is a dollar dropped into the household. It doesn't matter where it's coming from. So as long as couples are making decisions together, you drop that dollar in, and it should affect the individual's labor supply irrespective of its source, or its, where it's originally coming from, whether it's coming from the taxable labor income of the individual or the spouse. The way that we can test this is by simply estimating the effect of the labor earnings of the individual on the total change in after-tax income of that individual as well as the spouse. So we're effectively going to drop both in, exploit the differential responses to the reform across individuals and spouses, and see if either one of them come out statistically significant. I should mention as well that here I've labeled it as the individual and a response to the spouse with I and S respectively. You can flip that. You can do it on S and the responsiveness to S and I. I show those results in the paper, and you get more or less symmetric responses as well. But under the collective model, what we would expect then is because a dollar is a dollar is a dollar, these parameter estimates should be more or less equal to each other. And what we find is that that's simply not the case. Along the intensive margin, it does appear as though individuals are responding to a change in the spouse's labor earnings, but exactly as I showed before, not really so much for a change in the total after-tax income of themselves. They do continue, however, to remain responsive to their average net of tax share. Along the extensive margin, it's a little bit less clear-cut. So here we get estimates that are different from each other, and they're statistically different from each other. I'm reluctant to hit that home too much, given the fact that they are still, in a qualitative sense, relatively similar. So I don't want to, in the paper I say we reject the collective model empirically, but on a qualitative sense, it does appear as though there are still cross responses. I think that's really important here because it's not too clear. I mean, it's a large data set, and we have very precise confidence intervals and so on and so forth, but at least from a qualitative standpoint, it does appear as though there is some behavior that's at least somewhat consistent with what you'd expect. Okay, cross-spouse labor effects then. The idea here is that individuals prefer to work and retire together. So there's a direct complementarity of leisure between individuals and spouses. And so as a result of that, not only should there be an effect of a tax reform indirectly through the tax liability of the spouse, as I just showed you, but there should also be a direct effect on the individual's and the spouse's labor supply. So if a change in the tax liability of a spouse affects how much they work a little bit less. I might be more inclined to work a little bit less as well, just because we like to spend time together at home. The way that I can estimate this is just by regressing the labor earnings of the individual on the labor earnings of the spouse, and controlling, of course, again, for all those other characteristics that could affect this decision making. The way that I identify this credibly is by using the spouse's tax rate as the excluded instrument in this regression. The idea here is that because the unit of taxation in Canada is the individual, ultimately the spouse's tax liability, the spouse's tax rate is only levied on the spouse's labor earnings. So we can use the spouse's net of tax share as an excluded instrument because of the fact that it's only levied on the spouse's earnings. What we see when we do that is, interestingly, the relationship is negative. What this tells us along the intensive margin is conditional on both spouses working. When one spouse works a little bit more, the other spouse will actually work a little bit less. So whether that's substitution towards home production or simply just the result of the fact that the household together needs a certain budget constraint, and so as a result of that, the other individual can reduce a little bit. It's not entirely clear what's driving this result, but ultimately there is a negative relationship along the intensive margin. We see it along the extensive margin as well. So what this tells us is as the spouse moves from being from being not employed to being employed, so as the spouse joins the labor market as a result of a change in tax liabilities, the individual becomes about 12 percentage points less likely to be employed. So there seems to be some sort of substitution in this case. Okay. I also run this across different groups. What I find, first of all, is that men appear more responsive to changes in their own taxes. In contrast, women appear to be slightly more responsive to what's going on in terms of the tax liabilities and the labor supply of their spouses. I also find relatively robust results across the income distribution. So it really appears as though this result is being driven by the middle of the income distribution. There's not a lot of heterogeneity along this margin, which is interesting. And I also find a bit of difference in terms of whether the household still has kids present at home, as reflected on the tax records. So I find that cross-spouse income and labor effects are larger among couples with kids. Couples without kids, on the other hand, are more responsive to direct changes in their tax rates. This just might reflect the fact that, for example, couples without kids don't have as much financial constraint, and so as a result, they have the flexibility to adjust their labor supply a little more. I should also mention, because we are focusing on older workers, the percentage of individuals who still have kids at home is relatively small. I think it's in the range of 15 or 17%, but it is fairly small. So in conclusion, what this study has shown is that the tax code is a viable policy lever for influencing the labor income and employment decisions of older workers. But what's interesting about that is depending on whether you're looking at the intensive or the extensive margin, the type of response differs. And in addition, the type of response is not always consistent with what you would expect from standard economic theory. In addition, there are significant cross-spouse effects of tax reform, but the collective model is rejected empirically. And so one thing I just want to emphasize from this is that in the large literature, whether it be in, say, the Canadian context where you're looking at individual tax responsiveness, or whether you're looking at, say, in the United States, the large literature on elasticity of taxable income that tends to look at family-level income responses to changes in taxes, what this study shows is that, in fact, just looking at the family-level earnings response to a change in tax rates is missing an important margin of adjustment. So there's things going on within the household. There are distortions occurring within the household, such that if you're only looking at what's happening at the household level, you're missing those levels of adjustment. So the welfare implications and the policy implications can change once you start to take that into consideration. And this is a point that Alex Gelber has made in a paper looking at Swedish data. The results that I found here for cross-spouse effects are fairly similar in Canada to what you see in Sweden. But this adds to this literature that we need to be thinking of what's going on, not only for household level responses, but also within the household too. Okay, thank you.